A teacher in New York can work for 40 years and still watch half of their retirement disappear in a market crash. At the same time, a family in Shanghai can spend 3 generations saving only to lose everything on an apartment that was never even finished. Different countries, different systems, same outcome. So here's the question no one is asking. Why do completely different economies keep producing the exact same financial ending for ordinary people? Most people think the explanation is simple. In the West, they trust the stock market. In the East, they trust real estate. Different cultures, different preferences, different choices. And on the surface, it makes perfect sense. If you grow up in a system with strong financial markets, clear regulations, and decades of stability, of course you would trust stocks. If you grow up in an environment where markets feel unpredictable, where information is uneven, you hold on to something you can see and touch. Land, property, concrete. So, we tell ourselves a comfortable story. People just choose differently based on what they believe is safe. But that explanation is incomplete because it assumes one thing that may not actually be true, that people are freely choosing at all. The real difference is not what people prefer. It's what the system needs. You're not choosing between stocks, real estate, or saving. You're being guided often without realizing it into the asset that your system depends on to survive. In some economies, money is pulled into the stock market to fuel corporations and financial growth. In others, it is pushed into real estate to stabilize banks and drive expansion. Different assets, same function. They are not just investments. They are reservoirs designed to absorb your savings and quietly determine what happens to your financial future. This is Mind Over System, where we break down the hidden structures shaping your decisions, long before you think you've made them. There are 3 mechanisms behind this, and once you see them, you won't look at money the same way again. Mechanism 1. Every system needs a place to send your money. Every economy has a problem it must constantly solve. What to do with the savings of millions of people? Because money sitting still is useless to the system. It doesn't grow businesses. It doesn't create jobs. It doesn't generate control. So instead, systems are designed to channel that money somewhere. In the United States and much of the West, that somewhere is the stock market. Not because it's inherently better, but because it serves a very specific function. It allows corporations to continuously absorb capital from the public. Think about it. When you buy a stock, you're not just investing. You are providing liquidity to a system that depends on constant inflows to keep expanding. And the most powerful force behind this is not individual investors. It's institutional money, retirement funds, pension funds, index funds, trillions of dollars that are required by design to keep flowing into the market regardless of whether conditions are good or bad. They don't buy because they want to. They buy because they have to, which means the market always has a buyer, a massive, predictable, unstoppable buyer. And once you understand that, you start to realize something uncomfortable. The market isn't just a place where wealth is created. It's a system engineered to continuously absorb the savings of the population. Mechanism 2. When the entire system is built on the price of land, if the stock market is the reservoir in the West, then in many Eastern economies, that role is played by real estate, but not because people simply prefer land. That's the surface explanation. The deeper reason is structural. In these systems, banks don't lend based on future potential. They lend based on collateral. And the most powerful form of collateral is property. Land, apartments, buildings, which creates a feedback loop that is almost impossible to break. Businesses use real estate to secure loans. Banks feel safe because the loans are backed by assets. That money is then used directly or indirectly to buy more land, build more projects, expand more developments. As demand increases, prices rise. And as prices rise, the value of the collateral inside the banking system rises with it, which makes banks even more confident to lend more money, more loans, more construction, higher prices, again and again. A system feeding itself on the assumption that property prices will keep going up. But here's where it becomes dangerous. Because once an entire financial system depends on rising property values, real estate stops being just an investment. It becomes a pressure point, a single valve that policymakers can open or close to control the entire economy. Open the valve, credit flows into property. Construction surges, jobs appear, growth accelerates. Close it, liquidity dries up, projects stall, and the system begins to freeze. And when that valve shuts too quickly, you don't just get falling prices. You get unfinished buildings, frozen savings, and millions of people realizing their safe asset was never really safe at all. Mechanism 3. Inflation doesn't disappear. It gets redirected. Most people think inflation is simple. Prices go up. Life gets more expensive. But that's only the version you can see. Because in reality, inflation doesn't just affect what you buy. It affects where money is sent. When central banks create new money, and they always do, in one form or another, the money has to go somewhere. And there are only two possible destinations. The first is the real economy, into wages, consumption, everyday goods. If too much money goes there, you get immediate pain. Food prices spike, fuel becomes expensive, and people feel it instantly. That kind of inflation is visible and dangerous. So there's a second option. Instead of letting money flow directly to people, it gets redirected into financial systems, into stocks, into real estate, into what looks like investment. And when that happens, something strange occurs. Asset prices start rising much faster than everything else. Stocks climb. Housing becomes unaffordable. But everyday goods? They increase, just slowly enough to avoid panic. From the outside, it looks like growth. But underneath, it's a transfer, a silent shift of purchasing power. From people who earn money to people who already own assets. And this is the part most people never realize. You're not just trying to keep up with inflation. You're competing against a system that is designed to make assets run faster than your income ever can. You don't need complex data to see this. You've already lived through it. Look at what happens after every major crisis. After 2008, when the financial system nearly collapsed, trillions of dollars were injected into the economy. But did everyday life suddenly become affordable? Or did stock markets begin one of the longest bull runs in history, while housing slowly drifted further out of reach? Years later, during the pandemic, even more money was created in an even shorter time. Again, the pattern repeated. Asset prices surged. Technology stocks exploded. Real estate prices climbed at a pace most incomes could never match. At the same time, something quieter was happening. People who relied only on salaries found themselves working just as hard, but falling further behind. And in systems heavily tied to property, we've seen a different version of the same story. Entire cities built faster than they could be filled. Developers collapsing under debt. Families paying for homes that may never be delivered. Different headlines. Same underlying pattern. Money doesn't just circulate. It gets directed. And once you see that pattern, it becomes very hard to unsee. Imagine a young professional in their late 20s. They did everything right, got a stable job, saved a portion of their income every month, avoided unnecessary spending. For years, they watched their savings slowly grow. At first, it felt like progress, but then they started paying attention. The apartment they were hoping to buy didn't just become slightly more expensive. It moved further away every single year. Not by a small margin, but by a gap their salary could never realistically close. So they tried to adapt. Maybe investing in the stock market. Maybe taking on a loan earlier than planned. But no matter what they chose, they were entering a system where prices had already been pushed up by forces far bigger than their own effort. And that's the moment something shifts. Not in their bank account, but in their understanding, because they begin to realize they are not just trying to build wealth. They are trying to catch up in a race that started long before they even entered it. And when millions of people are in that same position, this stops being a personal struggle. It becomes a structural outcome. An entire generation working, saving, planning, yet constantly feeling like they are one step behind, not because they lack discipline, but because the rules of the system quietly shifted beneath them. Wages move slowly. Assets move fast. And over time, that gap doesn't just grow. It compounds. The people who already own assets see their wealth expand almost automatically, while those trying to enter the system have to take on more risk, more debt, just to participate. And that's how inequality deepens, without needing a single dramatic event. No collapse, no sudden crisis, just a slow, consistent transfer from those who earn to those who own. And the most unsettling part is this. The system doesn't see this as a failure, because from its perspective, everything is working exactly as intended. The system doesn't need you to lose money. It only needs one thing. Your money grows slower than assets. That's it. As long as your salary increases by 5% a year, while housing or stocks rise by 15-20%, you will feel like you're moving forward. But you're actually falling behind. Not suddenly, not dramatically, just a little, every single year. And that's why most people never notice it, because nothing feels broken. You still have a job. You're still saving. But the finish line keeps moving, faster than you can run. So the real trap is not that the system stops you. It's that it lets you keep going, just slowly enough to never catch up. So this isn't about escaping the system, because you can't. You still have to work. You still have to earn, save, and make decisions with your money. But once you see how the system actually works, something changes. You stop assuming that effort alone will get you ahead, and you start asking a different question. Not, how do I work harder? But, where is my money being pulled? and who benefits from that direction. Once you see this, you can't really look at money the same way again, because it's no longer just about how much you earn, but about which system your money is feeding into and how that system decides to reward or outpace you. And this is only one piece of a much larger picture, because the same kind of hidden structure doesn't just shape your money, it shapes your career, your opportunities, even the choices you believe are yours. The question is, now that you've seen one part of the system clearly, how many other parts are still invisible to you?